What is up, ladies and gentlemen, boys and girls, real estate agents, loan officers, home buyers, homeowners, prospective homeowners, humans, everyone? Welcome to Fed Week. Welcome to the Monday Market Update. This is always a fun week. We get to put out our predictions, and then next Monday we get to ignore them because they're always wrong. My name is Sean Grapevine. I am Vice President of Product Strategy here at UMortgage, and I am joined by the one, the only, Matt, the mortgage guy, Gouget, former poker dealer, current YouTube star, future President of the United States.
No chance. Future President of the Sacramento Kings basketball organization. That could be true, but I don't think I'm running for president. But excited to be with you here, Sean. This is a exciting week. We are gonna, talk about what the Fed is doing this week, what it does and doesn't mean for mortgage interest rates, because people get confused. And I'm gonna hold you to a prediction. We should probably place a wager on that prediction.
Sure.
What not only the Fed is going to do, but what that's going to do to mortgage interest rates. So be ready, bro. Get your wallet out, Mr. Grapevine.
Okay, well, I will, but I won't need it except for to accept your payments. Although I think we should do like are you going to Michigan in October? Matt, are you there? Uh-oh. We've lost Matt.
I may go to Michigan. Not
Well, guys,
gosh darn it. My bad.
Caden, why don't you kick him out for a second? There we go. And I'll host for a little bit. Let's see if we can't get his internet up to snuff. He has wasted all his money gambling on the futures market for interest rates and had to downgrade to dial-up. That's why he has such a bad internet connection. Anyway, as mentioned, it is Fed Week, the Tuesday and Wednesday, and they release their decision on Wednesday. But what they are going to do about federal interest rates, and we're going to discuss what those effects are on you, the loan officer, the real estate agent, the consumer, and what it means for you, and what we think is going to happen into the future. Before we do that and delve into the future, let us look back into the past and do the numbers. We have seen a steady decline in interest rates across all product types in the mortgage market over the last several months. It started off a little bit slow in July as some inflation numbers came in good, some jobs numbers came in bad. So bad news in the jobs market is good news for interest rates because it shows that the economy is cooling and that the Fed will probably need to do something to heat up the economy. And the way they do that is by lowering their interest rates. So you see here, we've had some pretty precipitous, by mortgage rate standards anyway, drops over the last few months. If you look back, this blue line up here is the just conventional loan rate, your standard loan rate. If you look all the way back into early July, you see a 7% on average. And then if you look right now, we're just over 6%. Depends on the scenario, obviously. But no matter what scenario, rates have dropped by about a percentage point. And they've dropped even steeper for the government loans, especially VA. So if you are a veteran and you haven't discussed using your eligibility to get a VA loan, then we highly recommend. It's the best loan on the planet, and you should talk to your local loan officer, maybe Matt Gouget, once he pays AT&T to get him off of the dial-up that he's on. Matt, are you there?
I am, and I was going to stay mostly quiet because I know, for some reason the internet is not cooperating this morning. Just got back into town. I haven't been in the office since last Tuesday because I was in New Orleans with a bunch of mortgage brokers from across the country. So I don't know what's going on with the internet over the last 5 days since I've been gone, but I shall figure it out today.
Yeah, no worries. I'll do the heavy lifting here. Feel free to shut down your computer and jump back in. I know we're on a pretty big delay here. So, yes, we would love to hear your questions, seeing as I am being left slightly on my own here, and would love to hear from you guys what your questions are about the economy, about interest rates. If you want me to explain like the nuts and bolts about how some of this stuff works, I would be more than happy to. It is something I really love doing. As mentioned, interest rates down. Let's get into what bond traders, so the people who buy and sell loans to and from the US government, what their predictions are. So this chart, we show it every week, shows the sort of like interpolated chance of what the Fed is going to do. You'll see here that there's two bars. One is for a single drop in interest rates to the 500 to 525 basis point range. That's 5% to 5.25% interest rate. And then you'll see here 4.75 to 5%. There's a 61% chance of that and a 39% chance of that. Now, this is interesting, and it's something I've sort of slowly learned over the years as we've done this, is that traders often lean too far in the direction of what they think. They over lean in those directions. They're doing something called hedging there, which means like it's a big deal if the market goes further than they guess. And so what you end up seeing is this sort of over lean towards a bigger move. I think most people, if you ask the actual traders making these moves, that on Wednesday, when the Fed comes out with their decision, they're just going to drop interest rates a single quarter of a point. So down to this 500 to 5.25% range. There's a chance, but certainly not an overwhelming chance, as this chart says, that they would drop it twice. The reason they would drop it twice is because the jobs numbers that have come out look a little scary. Inflation looks really good. But I think that the market would really interpret that as maybe kind of a panic move. And when you have those panic moves, then things get thrown out of whack. You'll see interest rates decline a lot, which is good. But you'll also see a lot of movement in the market. When interest rates drop, these bonds go up in price. It ends up affecting the stock market as well, because there's only a finite amount of money in this world at any given time, and people have to decide, do they want them in these bonds or do they want them in these stocks? And so it ends up having an undue effect on the entire sort of like trading economy. So should be interesting. My guess is that there will be a single drop from 5.25 down to 5% from the Fed come Wednesday. However, I am wrong about 100% of the time. So I'm always happy to eat my words. I wouldn't mind a double drop, but like I said, it does cause a little bit of chaos, and it does kind of project a certain level of panic at the Fed. Matt, you here on your phone?
I am back. I'm on my phone. Hopefully this is better. And this is a good point, like, for me to interject as somebody who, like, my whole job is to take all of this stuff. And when somebody calls, they're like, listen, I don't want, a lecture in economics. What the heck are the mortgage rates going to do? Which is what most people want at the end of the day. So me and you know this, Sean, but I'm going to repeat this as many times as I think I can, because people need to hear it. The Fed cutting the Fed funds rate, which is what we're talking about on Wednesday, is not going to move mortgage interest rates. They move in the same direction, and there is a correlation. But what I've told people, I literally talked to somebody on the plane flying home last night. All of this, like, we already know they're going to cut the Fed funds rate. So if they cut 25, 50 basis points, it's not like it's a big surprise. Like, oh my gosh, now rates are going to come down.
I actually don't know if I agree with you.
Well, feel free to disagree, Sean, but here's what I'm going to tell you. Let's say the Fed cuts 25 basis points, and sure, it can positively infect mortgage interest rates because it's the beginning of this rate cutting cycle. But if the Fed doesn't talk in a way that gives the market, the people that make the mortgage, market confident that there's going to be 200 basis points in cuts in the next 6 months, and I don't think that helps rates. I think it hurts rates. That's just my personal opinion. But, I just want people to not say what they've been saying, which mortgage rates are coming down Wednesday. That's what I've been hearing. And it's not really that simple. And that, like, they're like, oh, hey, rates are 6.25. The Fed's going to meet, and then they're going to be 6% on Thursday. Not exactly how it works, but give me your logic, man. I want to hear it. What says you?
Well, I think in a situation like this where the market is unsure of the level of cuts here. So basically, if taking a look at this screen, the average prediction is somewhere in between a single cut and 2 cuts. So I would say that no matter what they land on, we'll probably have a small but significant effect on mortgage rates, because if they only drop once, these 61% of people who thought, or 61% chance based on traders' past trades, is going to be rendered incorrect, and you'll see interest rates go up a little bit, because the way the market works is like these expectations are priced in. So typically what you see is if there's a 99% chance that there's going to be a single drop or single raise or no change at all, then you end up with no effect on interest rates. But when there's this sort of straddled expectation, if they only drop one level, you're going to see interest rates creep up a little bit. This is just a prediction, but I think I'm right. And if you see them drop 2, then you're going to see a major shift down, because I think that's kind of outside of expectations, despite what this chart says. So I do think that, like, on day 1, there is going to be a creep up or a creep down that's more significant than a typical day, depending on what they choose. I do agree with you, however, that it's not going to be this, like, because if you go into, what this looks like in May of next year or something like that, like, their decision today doesn't have a huge effect on what the eventual, what the curve looks like on the way down. It just affects its slope a little bit. What are your thoughts?
Yeah, I agree. I think what kind of makes me a little bit crazy is rates have gone down a full percent over the last 60 days, and people are waiting for Wednesday, September 18th, like that day is something special. If your hope is interest rates coming down, and that's what's going to spark you to go out and rerun numbers and maybe get back out in the market, like, that's already happened. September 18th ain't anything to wait for, because to your point, Sean, if they only cut a quarter, and for whatever reason they're like, hey, we're going to take this slow, that is going to be on the less aggressive side of people's expectations, and that's going to hurt mortgage interest rates. So somebody who's like seen rates go from 7.25 to 6.125, oh, let me wait till September 18th, and then they do less than we think, and they go to 6.25, 6.375. They're going to be like, oh, maybe I should have looked at it at 6 1/8 and been excited about it then.
Yeah, I totally agree. So what's your prediction? 1 step down or 2 steps down?
Gosh, I'm such a freestyle guy that I haven't thought about it. So give me 4.5 seconds. They are going to go with 50 basis point cut.
Whoa. Okay. I said 25. I just say 50 is, it's going to look like a panic play if they do that.
Yeah. I mean, I truly think, like you said, it's a 50-50 kind of straddled, like, prediction. And I can see them doing either one. I can see the merit of, like, let's hit it with 50 and then see how that affects the market. And they could even do like a 50 and then a 0 in the next meeting, or they do a 25 and a 25. I think our expectation still that we're going to have like 4 moves in the next 3 meetings.
Let's move into that. So current expectation somewhere between 1 and 2 on this month. And then there is no October meeting. There is one on the 7th of November. And if you see here, some people think that there will just have been like maybe the second move down here. And then most people think this is not percentage of people who think a certain way. It's the interpolated odds based on all traders' trades. So there's a 50% chance of 3 steps down total, and then a 31% chance of 4 steps down. So again, yeah, it's like, well, if there are 3 steps down, then in one of these 2 meetings, there has to be a double step down. My guess is they start with 1. I think there's just going to be 1 per meeting for the rest of the year. But if you look to the end of the year in December, you actually see that only has, nobody agrees with me. There's only 6.7% chance of that. And the highest chance is a 5th step down. So a 2, 2 and 1, or 1, 2, 2, or 2, 1, 2 has the highest chance. And you even see a 6th step down. To me, I just don't see that the economy, as far as the numbers that economists use, you can have your issues with whether or not you agree with how we calculate inflation, how we calculate jobs numbers, and plenty of people do. But those numbers are the numbers that that the Fed uses. And so far, there's no reason to panic. Now, Jerome Powell has come out and said, like, and pardon this beautiful graph made by the Bureau of Labor Statistics. They didn't put quite as much work into this one as they have their other ones. But this is a look at the number of jobs created per month since January of 2022. And you see, like, these are basically huge steps up here. And these include the revisions that have been done, much to everybody's surprise and chagrin. You see these big steps up, and these are essentially just like COVID recovery, right? Like, this is the economy recovering COVID jobs. And I think it was like in late 2022 when they came out and said, like, we've caught up to where we would have been had COVID not happened. So this is an actual picture of the labor market here. And you see 200,000+ jobs in most months being created throughout 2023. You see a strong start to 2024. And then it starts getting a little bit dicey. And we saw, only 85,000 jobs created in July, and then August was like 165. Not great. I think the Fed would prefer something around that 180 to 220 mark every month. Again, though, it's not like, and inflation is still at 2.5%. So it's not gone by any means. There's still some work to do. But the Fed's job is to make sure that, like, they don't affect the job market any more than they absolutely have to. And Jerome Powell's come out and said, like, I forget, his quote was, "We do not seek or welcome further cooling in labor market conditions." So the question is, have the increases in interest rates, how long, right, does that take to affect the job market? And then how do decreases in rates, how long do those take to re-improve the job market? Obviously, it takes a while for this money to, fully work its way through the system. And, I mean, when we hire somebody, right, even if we have a job opening, I was talking with our team last week, we have a job opening that we have to develop the role for, create a job description for, create all these KPIs and metrics and all that stuff. And we're like looking forward to hopefully hiring this person in January. So, and we move fast. So there's like, it takes a long time for these things to work their way through the system. And so the Fed's always kind of playing on the back foot here.
Yeah, no, I agree. And that's, lagging data is kind of what's put us into this problem we're in. When we look at inflation too, like the 2.5%, some would be like, well, if you stripped out the housing cost, which the data lags, some would say like 12 months on that, then, inflation might be at or below Jerome's target. So yeah, it'll be interesting to see. Cause I think while it does take time, like the lower rate being a positive thing for businesses so they can hire more and they can scale and whatnot, probably I would think with technology companies and today's kind of like marketplace, a little bit faster than it would have been 20 or 30 years ago with companies that probably move slower than they do today.
Yeah, I agree. It should be interesting to watch. And Jerome Powell will talk about most of what he will say on Wednesday will have to do with the labor market itself and the effects of inflation and monetary policy on that. So it should be super interesting. I can't wait to see what happens Wednesday. I love that that you say double step down, I say single step down. One of us is going to be correct and be crowned champion of.
What did I take again? I went double step down. This is how I pick my football pool picks. I like just circle teams. I'm like, who'd I get again?
Yeah. Thankfully, I have removed myself from the tyranny of fantasy football. I'm as good at that as I am at predicting rate markets, which is to say, not good.
Do you see Jay Homeboy?
Yeah. Why don't you take that question?
Yeah. So thanks for joining us, Jay Homeboy. I appreciate the question. This is a common topic, and I was going to say something earlier. Saw a stat while I was at this conference. Our buddy Barry Habib shared some cool stats about, quote unquote, in the money refinances. For somebody like Jay Homeboy with a $500,000 balance, it doesn't take a humongous rate drop for him to be in the money for it to make sense to refinance. Quick numbers on refinance market at 6.5%. There's about 2 million people in the money that did a loan between 22 and 24. When we go to 6%, there's another 2 million. We go to 5%, there's another 2 million. So there's going to be, 6 million people over the next 9 to 12 months probably that are in the money to refinance. So this is a good question. What's the typical cost given the par rate? And so anybody who wonders what par rate is, that's the rate that doesn't cost anything. So in your scenario, Jay Homeboy, let's say that you got a 7.125. We tell you that, hey, we can get you 6.25 and that's par, it doesn't cost anything. The average cost and whether you come out of pocket with it or not doesn't really matter. Money gets rolled in the loan, that's still cost. Appraisal might cost $600. Title fees might be $2,100. There's going to be.
Do you guys have a mortgage stamp tax?
Kind of, yeah, like 385 or something. I don't know what it's called exactly, but it's
ours is 0.3% of that. So for 500, it would cost an extra $1,500 in Georgia. Ugh.
Okay, yeah. So this is the cool part. I'm talking about California, but like to Sean's point, Georgia's got this stupid stamp tax. I'm doing a refinance in Florida. They charge transfer taxes on a friggin' refinance. Who are we transferring to? It's the same friggin' borrower. No, ain't no transfer going on. And so know what the cost is of your refinance. To your point, Jay, like probably 3,000 is a good number to guesstimate. Maybe 3,500 if counting days of interest, counting prepaid taxes and insurance, I don't do because like those things are something you pay anyway. Like true costs of a refinance, probably $3,000. If you're buying the rate down a little bit, maybe it's a little bit more, but you take that and you say, I'm going 7 1/8 to 6 1/4. I'm saving $380 a month. If the cost that is being rolled into your loan is less than $3,800, you're breaking even in less than 10 months. That's something where you pull the trigger. That's called a go. You want to refinance that bad boy. In other states, it's like Sean said, it's different. You got to factor in the stamp tax. I'm doing one in Florida. I'm like, man, it's going to save $480. This one's sweet. We get that friggin' transfer tax, and I'm like, oh my gosh, $3,700 in transfer tax? Ain't nothing being transferred.
Yeah, it's ridiculous. But if you're saving almost in any case, if you're saving $200 a month, even if it costs $6,000, right? That's a 30 month like break even period. And while that's not fast, as long as you plan on living in the house for longer than 2 years and 4 months, like it may make sense.
Right. Yeah. And I think everybody's different. What I've been trying to do lately is present everything, show people that break even. And some people like, I don't know what you don't want to do. And what we looked at this week with Barry Habib as well is somebody's like, wait, 6 1/4 sounds good, but I'm going to wait until it gets to 6 1/8, because I want to save a full percent. Instead of saving 380, I want to save 410. What you could do, because you're waiting to save $30 extra, is you could wait 4 months. And we have there's no guarantee it gets to the 6 1/8, but let's say it takes 4 months to get there. So you've paid an extra $380 for 4 months. Quick math, 1520. 1520 divided by the $30 extra you're saving. That's about 50 months, 50.66 months. If you want to know if I've had my coffee or not, Mr. Grapevine. Yeah. Well, math. Math is my thing. So
they call him Math the mortgage guy.
Yeah. So don't get caught up with like, oh, I need this specific rate, or rates have gotten better. I'm going to, if you have a strike price and you've analyzed it with a mortgage broker at 6.25, I'm going to save this. It's going to be a this far break even. It makes sense. Strike at that price. If rates continue to go down, great. Then maybe we'll look at it at 5.3. But don't, get caught up paying an extra 400 for an extra 5 months because you were an eighth away from where you just want to squeeze out a little bit more. Don't get greedy.
I think the cost of waiting is definitely something that people don't think about, but it is a difficult thing to take into account if you have a pretty high confidence in those rates going down relatively quickly. So it really just depends on like your level of comfort, and all you're doing is, if you lock it in now, right, you've got guaranteed savings. If you lock it in later, you might have like a higher upside, but higher risk as well. Maybe rates never go down. Maybe the job market is better than we think it is. Maybe rates end up going up. Maybe the Fed reduces rates slower than we think they're going to. That will send rates up. Even though the Fed's reducing rates, it will send rates up if they do it slower than traders currently think they are. You have to understand that like the rates we're seeing right now have priced in the expectations of rate reductions over the next 6 to 12 months. So that is like, right now we're not dealing with how much is the Fed going to reduce rates. It's what is the difference between what actually happens and what we think is going to happen. And that's going to have that's going to be what drives rates. So, once you have the sort of like expected slope determined by the Fed, which they've done a very good job of really making sure that they communicate well, it's like, well, that's kind of what rates are right now. And the only thing that changes that is expectations being different from reality. Oh gosh. Well, guys, Matt is gone once again. It has been great. Jay Homeboy, hopefully we have answered your question. Next, Matt, welcome back. Next week is the What the Fed segment of Monday Market Update, where we go into what actually happens versus what the expectations are. It's like a little microcosm of what we were just talking about, and should be super fun. You'll get to see who was right and who was wrong, and you'll get to know what the terms of the bet were, which we haven't quite gotten to yet. So we'll handle that offline, Matt, and we'll make sure to exchange that thing of value.
Probably. Yeah, we'll have to say something live. Like you're going to have to say the Sacramento Kings organization is the greatest organization to ever live or something. Maybe like.
Do you think there's any chance that the Sacramento Kings like don't play in Sacramento sometime in the next 10 years?
Don't ever say that, bro. No chance. There will be expansion teams. There will be a Seattle team and a Vegas team. That's my prediction. But Sacramento's staying put. We got the greatest fans in the NBA. Are you out of your mind, Sean? You've said some outlandish things. That's the most outlandish thing you've ever said.
Well, last night I said the Braves are going to win the World Series when we were beating the Dodgers 2-1. Then the Dodgers put 9 runs on us in about 7 minutes, and I took it all back. So as mentioned, when it comes to predicting, I'm always wrong. That's my catchphrase.
The Kings win a championship before the Braves win, or the Dallas Cowboys win a Super Bowl. That's my prediction.
All right.
Thanks, buddy.
That sounds right. All right. Have a great rest of your day, Matt. Have a great rest of your day, listeners and watchers of the Monday Market Update. Keep your eyes glued to your favorite news site to see what the Fed actually does, and can't wait to tell you what the effect that has on the mortgage and housing market next week. Thanks, everybody.